We're seeing a lot of growth across the country in terms of infrastructure. There's a ton of momentum just given the sheer demand and need and energy transition and evolution. Our customers are grappling with making the right investment decisions because they have long-term implications, and it's investment decisions you'll live with for a long period of time.
That's JT Parker. He leads the credit team for our power, energy, and utility sector here at CoBank. And I'm Terry Vishwanath, the energy economist at CoBank and your co-host of Power Plays. As always, I'm joined by my colleague and co-host Tamara Reynolds, a managing director here at CoBank. Hello, Tamara.
Hey, Terry. To kick off the year at Power Plays, we wanted to talk about CoBank's expectations for how 2024 might play out, and more specifically, bring more awareness to the fact that CoBank works across multiple energy verticals. While we specialize in cooperative banking and hold a specific government charter to support rural community financing across lifeline businesses, our banking practice in other realms like project finance, utilities, midstream, and gas distribution gives us much more informed pictures of the total energy landscape, which helps us support our core cooperative customers better.
For this conversation, we caught up with some of CoBank's thought leaders. JT Parker, who you just heard from, who leads the credit team in our Power, Energy, and Utilities division. Matt Hale, a lead relationship manager within the bank's electric distribution team, and Justin Merkowitz, who leads CoBank's project finance group. Here's that conversation.
Just this week, I saw PJM, which is a regional market in the Northeast, tripling its annual load forecast for the next decade and increasing its peak load by more than 20%, which are pretty staggering numbers to think about.
From what I read, these future demand estimates are being driven by the growth of data centers, electric vehicle adoption, and new manufacturing. But first and foremost, it's the data centers. JT, what does this mean for the electricity generation side of the house?
We heard Jim Matheson, the CEO of NRACA, talking about the data centers and how to support them and what resources to support them with. That's an interesting point, and really you need kind of an all of the above, in my opinion, strategy to support a stable, reliable, affordable grid, or in the absence of new technology and with the technologies that we have today.
Let's provide a little perspective here. Electricity consumption at U.S. data centers is expected to triple from the current levels by the end of the decade, rising from around 2.5% of total U.S. electricity demand to somewhere closer to 7 to 8%. But what does all of the above actually mean in 2024? Matt, as we were preparing for this discussion, you talked about customer meter data and how electric co-ops are getting creative with balancing new demand. Can you expand on this? Also, I think I heard you say that co-ops can't manage what they can't measure. What does that mean?
Correct. I think another thing that co-ops are doing more and more, and I think they've had it at their fingertips, but maybe not necessarily dug into it, is data coming from their members. There's a lot of data coming from their members, but their ability to kind of fine tune and mine that data hasn't readily been available or something that they've maybe paid attention to as much. I think it's becoming more and more necessary for them to understand the data that's coming back from their meters, from their members, understanding their usage, and then trying to fine tune that data to develop rate structures that are appropriate for all members. Because one of the things that we're seeing as part of that data conversation is customers and co-ops across the country in both Colorado and Minnesota in the places that I deal with, data centers becoming a bigger portion or a growing portion of their load. And that requires a very fine-tuned rate structure in order to meet that, because high demand's a constant load for them, but there can be high shifts in regards to their power supply, and being able to fine-tune that demand to meet their needs through that data is something that's important to meet all of their customer segments that they deal with.
A Bloomberg headline caught my eye this week. AI needs so much power that old coal plants are sticking around. The authors of that article suggest that in order to cope with the surge in demand, and that's demand coming from data centers, power companies are reconsidering plans to mothball plants that burn fossil fuels.
I heard a generation and transmission co-op CEO last year talking about this very fact. and that the fundamentals, really of the next decade could potentially weaken to a scary point. I will say kind of recently in the news, I saw some announcements about previously announced plant retirements that have since been delayed due to reliability concerns. So I think there's recognition, in the markets about this. And so I think you're seeing a lot of broad support and concern over reliability.
JT, this general recognition is playing out in utility capital spending programs and ultimately to the burden placed on electricity consumers. The need to raise funds is in addition to the once in a generation infrastructure investment that the federal government is making in the form of grants and loans. In fact, the additional capital planning is in many ways a result of the infrastructure grant programs that only cover a small fraction of total spend and may lead to some financial deterioration in the short term for electric utilities. Matt, what do you make of this, and how might this fundraising alter traditional capital planning?
Co-ops are becoming more and more focused on reliability, and their ability to accelerate that reliability standard by integrating these grants to enhance kind of their overall capital structure is becoming very attractive for them. But from a cost standpoint, is maybe accelerating something that they weren't exactly planning for. So something to be thinking about, something that they're keeping on the forefront of their mind as they plan heading into 2024.
There is an historic amount of funding now available to fix the problem, so we can just move on. Right, JT?
I'd say some of the other generation challenges are just the challenges around building new infrastructure, right? Whether that's generation infrastructure or complementary infrastructure like transmission. And then you have all the permitting issues that are well documented, and the lead times that go into new construction related to supply chain issues and inflationary challenges that we have to deal with. I think there's both kind of a challenge with the existing generation fleet and how it's evolving, and also a challenge with new infrastructure and new generation.
The existing collection of federal, state, and local siting and permitting regulations is a major obstacle that would seemingly stand in the way of progress. But what about the equipment or warehouse procurement issues?
Supply chain challenges that began during COVID have continued to cause delays for co ops. This problem is further complicated by record demand for electric grid components nationwide and a shortage of skilled workers to produce those components. So, Matt, no relief in sight for 2024, right?
So, I think costs are another thing from a supply chain standpoint that co-ops are going to continue to struggle with and have to plan for, because as we talk about this, co-ops' biggest expenses are their power supply, inventory, and then kind of interest expense. Those are kind of three big categories that co-ops have to manage to. And I think that's going to continue to be something that they have to look for, plan for, and appropriately manage in order to manage the overall costs to their member owners.
Hey, Justin, you've been quiet so far, but I want you to weigh in here. Your project finance team sees a significant amount of the new generation that will be developed in the next decade. Before joining the bank, I didn't realize that CoBank's project finance platform has been around since the mid 90s and is consistently in the top 10 of the league tables for the last decade. Because we underwrite anywhere between $1.5 billion to maybe $2 billion of transactions each year, I think this is something you can weigh in on. So let's talk about the new build cycle and what impact this massive federal investment is having on those projects.
2023 was a very interesting year because it was kind of on the heels of coming out of COVID, and we observed a lot of supply chain disruption, high inflationary environment, interest rates were very volatile. That very much impacted the project finance world because all-in capital costs were significantly higher after we'd observed several years of declining costs for these various technologies. And so compared to 2022, where you saw a vast proliferation of projects that were a mix of either contracted profiles or relying on merchant cash flows, where the cash flows were not contracted, 2023, actually, that environment created an uplift in PPA prices to recover these higher capital costs. That actually worked very favorably for lenders because it resulted in a lot more contracted opportunities, which is very much more of our sweet spot in terms of our credit appetite.
Okay, so rising costs. Are the federal subsidies offsetting some of these rising costs?
The Inflation Reduction Act helped offset a lot of these higher capital costs because of the tax credits vis-a-vis the ITC and the PTC, making these projects more economic for the sponsors. But it did create a human capital constraint across all levels of the value chain. that we've seen across lenders, even the sponsors, the market consultants, the attorneys, everyone across the board. We saw sponsors wising up to that aspect of the market, and they were looking to scale up their transactions, better pricing, because ultimately sponsors needed to attract lenders to their projects because there was so much competition in the market. We may see RFPs much more in advance than we did in prior years, which makes it increasingly difficult for trying to tee up your resources.
In my mind, I'm envisioning these mega RFPs are sort of like massive highway billboards that are signaling to the industry a huge buying spree ahead. And it's already tough to source these grid components that Tamara talked about. But switching gears, are there other aspects of IRA financing surprises that we should talk about that are going to impact 2024?
Probably the other big theme of the year, I would say, is transferability. So, with the Inflation Reduction Act, obviously opened up this swath of tax appetite vis-a-vis the transferability market. Historically speaking, we have relied on traditional tax equity investors, which are large investment grade financial institutions, that would step in into a tax equity partnership to monetize the tax credits. What the transferability market did was pretty much open the door for any entity that has tax appetite in the market, and ultimately shifted to us getting comfortable with counterparty risk that we weren't accustomed to seeing. We still are trying to get our heads wrapped around how liquid the market is and what the prevailing prices are for those tax credit transfers. We've kind of heard a range of 90 to 92 cents, of which the lenders will structure the tax equity bridge facility as an advance rate against the 92 cents to try to build in cushion. Nobody disputes that there'll be appetite for these tax credits. It's just a matter of us observing how the market unfolds and how the mechanics actually work.
Renewable energy is clearly the winner when it comes to these federal subsidies. But 2024 might also be the year of the battery. In fact, battery storage will probably make up 20% or more of the US capacity additions, rising from around 17.5 gigawatts to somewhere around 31 gigawatts by the end of the year. Matt, what's driving co op interest in this technology?
I've got a great customer that I work with in regards to kind of being proactive, has implemented batteries as part of their system. They're seeing this truly materialize in regards to cost savings because they're able to manage demand to where sometimes they've been able to, because of weather events and things of that nature, being able to materialize that into maybe $1 million worth of savings on a daily basis. Obviously dealing with a cooperative that has some size, but I mean, I think truly hitting home in regards to doing what's in the best interest of their members to deliver reliable, affordable power day in and day out.
But from a market perspective, how have these investments fared so far? Justin, what are your thoughts here?
It appears that the investment thesis out of the gate on value stacking hasn't materialized in a way that we first perceived. We've seen a lot more fully contracted opportunities for battery storage in the form of either long-term tolling agreements with investment grade load serving entities or 5, 10, 15-year resource adequacy contracts.
So the market's had to pivot in order for these projects to now pencil. I've got it. But in that vein, what's going on with offshore wind generation? There was a terrific MIT article that mentioned that 40% of the global population lives within 60 miles of the ocean. So offshore wind farms seemingly should play a critical role in meeting the gap that JT discussed. But last year, a growing number of those projects were delayed or canceled as their costs skyrocketed. Justin, what's going on for that segment?
Even before all the disruption in the supply chain and inflation, offshore wind was already fairly expensive. And as you've probably seen in the news, with these inflated capital costs, they're just not penciling anymore for the developer, and it's resulting in some pretty significant impairments. We also recognize that there's a ton of RFPs in different markets around the country, and some of our most important relationships have development pipelines in offshore wind. It's going to be interesting to be seen if the capital costs start to decline, and probably more importantly, if permitting becomes more seamless of an issue.
Justin, how about the other technologies that the federal government seeks to underwrite? Hydrogen, for example.
The key challenges for hydrogen projects are significantly high production costs, and then uncertainty around the incentive and the mandate programs that exist, which really presents challenges from a financing perspective. I don't think we're going to see a large utility scale hydrogen facility in the market that's financeable in 2024. 2025, 2026, perhaps. But those deals seem to be getting funded mostly on balance sheet or with significant government subsidies. The other technologies that we've been hearing about, carbon sequestration and carbon capture, I think, again, probably in the very early stages, albeit we are hearing some whisperings from some of our customers that they've looked at these projects. Obviously, with the USDA, DOE backing for some of these projects, they may become more attractive. But again, probably haven't been tested to scale that these are broadly financeable in the market.
Any others that we should talk about?
The other technology I wanted to highlight is fuel cell technology. While CoBank has not pursued a transaction in the fuel cell space, we recognize it's kind of a similar investment thesis to battery storage and the fact that they're actually smaller in terms of the size, very modular. They're typically for a C&I application, generally low operating risk, albeit probably in a more accelerated replenishment cycle. But there's somewhere to the tune of 5 to 600 million transactions that have floated for fuel cell technology. So that's another area we're kind of paying attention to.
JT, I think you wanted to chime in here.
Some technologies we've seen take steps forward recently, and there may be some important milestones in 2024, including with a key carbon capture project up in North Dakota, which is being led by a generation and transmission cooperative.
We haven't really discussed massive changes in delivery. Will 2024 prove to be a breakout year for transmission? JT stressed the need, but are we seeing any movement here? Justin, is there anything here that we can get excited about?
There was a major flagship transaction that closed that CoBank played a big part in, which was the SunZia financing, which was a massive $10 billion capital raise. And we were proud to be the co-documentation agents there. A massive amount of capital to be raised across the market. That's about 3.2 gigawatts of wind generation in New Mexico with the transmission line that begins in New Mexico, works its way up through Arizona into California. Very important project and kind of setting the tone for other major projects of similar nature that are expected to come to the market in the next 2 years.
We are now in the midst of an economic period we haven't experienced since the 1970s and maybe early 80s. Structurally high interest rates and inflation, and those are the conversations that we've had today. But is this economic environment impacting capital decisions or financing appetite? JT?
There was certainly a demand for shorter dated and shorter tenor paper. So historically, where you'd seen the lower interest rate environment, maybe you'd see 30, 40-year debt and a high interest from the utility companies, and that where you saw a significant shift to 5 years, maybe 7 years. That brings its own challenges in terms of a refinance event down the road where who knows what the interest rate environment is. But you are seeing the lack of significant appetite for locking in the rates for significant periods of time that maybe you saw 2 or 3 years ago. So that's been an interesting development that we've been able to follow. And also kind of creative solutions around interest rate management. We've got a derivatives team that offers a lot of flexibility around how you want to manage your interest rate risk. That you can manage a portion of it, you can manage all of it, you can use swap options, you can use different types of instruments to manage that risk. I think there's just a lot more focus, given the interest rate environment, on how do we make the best decision on behalf of our customer owners and on behalf of our utility ratepayers.
One of the things that I would speak to as we kind of talk about the volatility, obviously, from a rate standpoint, and the flexibility there is being able to take advantage of swings like we talked about on a daily basis and locking those rates out maybe into the future. But I think the other important piece of it all, as we kind of talk about flexibility and previous conversations around technology, is as technology becomes more and more part of the electric co-op system, it's not just your 30-year financing that you put in place and away you go, because the evolution of these assets, as we talk about technology, is maybe they're 10, maybe they're 12, maybe they're 15-year assets. It's thinking about the assets that you're putting in place and then the debt structure that's associated with it. So maybe you do a new AMI system. That's not something that you integrate as part of your 30-year work plan. It's something that you probably put out on 10, 12, 15 years. So you're matching the useful life of those assets with the financing that's associated with it. So, I mean, I think that's the evolution that we're kind of starting to talk with customers about, that we're thinking about, and that we're trying to be partners with in regards to our members in structuring debt appropriately for the assets that they're putting in place.
There are financial strategies that our co ops utilize to mitigate costs, such as accelerating projects where it makes sense, utilizing technology, and managing customer rates. But I want to understand how borrower and banker coordination might aid the financial agility equation.
Flexibility is key, more so now than it has been in times past. I mean, if we look historically at times past, the rates were sub threes, 3.5 maybe, and it was kind of a set it and forget it mentality. I mean, you didn't really have to do a whole lot of planning. You didn't have to do a whole lot of thinking in regards to, hey, 3.5%, maybe 3%. We set the rate at 30 years and we move on. I think in this interest rate environment where we're seeing an elevated level of interest rates, we're also seeing very volatile swings within a daily basis. Sometimes on a daily basis, we'll see 25 to 30 basis point swings. And co-op's ability to be flexible in working with CoBank allows them to take advantage of dips on a daily basis. Our ability to be proactive with our customers, as we talk about proactive nature in regards to electric systems, it's our proactive nature in regards to interest rate management with our customers. So it's those co-ops financially planning more into the future now than they've had to in the past is becoming key in regards to helping CoBank plan and be proactive in regards to their rate needs. Being in this role and interacting with customers is what allows us to drive success for our members, is that we get together, we talk about it, and that we facilitate great conversations that help them plan for the future.
I want to thank our CoBank guests, JT, Matt, and Justin. It was really great to hear your insights on the new year. I hope all of you have found this conversation helpful. One of the really important themes for future investment is the growing electricity demand, especially around data centers. For next month's discussion, we're going to catch up with experts who shed light on how data technology, namely artificial intelligence, might be applied to the electric industry.
We're going to catch up with Dr. Jeremy Renshaw, who currently leads EPRI's effort for artificial intelligence. Bye for now. CoBank's Power Plays podcast is intended for informational purposes only, and the information should not be used without CoBank's express written permission. The information provided in the podcast is not intended to be investment, tax, or legal advice and should not be relied upon by listeners for such purposes. The information contained has been compiled from what CoBank regards as reliable resources. However, CoBank does not make any representation or warranty regarding the content and disclaims any responsibility for the information, materials, third-party opinion, and data included in the podcast. In no event will CoBank be liable for any decision made or actions taken by anyone, person or persons, relying on information contained in this podcast.